Hello and welcome to the Index Investor, where we explore the smartest, simplest, and most efficient ways to build wealth. Today, we're asking a big question. Can you go passive all the way for retirement? From building your corpus to generating income after you stop working, can index funds really do it all? To help us decode this, we're joined by Madhav Bhushan of Bharat Bhushan and Company. Welcome, Madhav.
Hi, thank you so much for having me.
Great to have you with us. Madhav, let's begin this conversation with, can someone really plan their entire retirement using only index funds, or do they need active funds or other products along the way?
So I think the equity side of it can be managed entirely with index funds,
Okay.
considering the large inflow of various indices also that we've seen in the last 5 years. And obviously more options, because earlier there was only benchmark, which became B's, then it became Goldman Sachs, then Reliance, then Nippon. But now you have, at least 15, 20 AMCs, which have introduced index funds. So you have a lot of options. Having said that, I think you do need some other products as well, especially on the debt side. On the commodity side, it's a personal choice, because there are distinct advantages of holding ETFs when it comes to gold and silver. But it's also, I think, a matter of personal preference, because it's a tangible asset. Some people like to hold it in physical form. Some people by default hold it as jewelry. So on the equity side, yes, I think you can, if you want, rely completely on index investing for retirement.
And what kind of index funds work best for the accumulation phase? So when someone is saving for retirement, should it be Nifty 50, Nifty 500, or a mix of both? What should the mix be like?
So obviously, it will change from person to person depending on their risk profile.
Mm-hmm.
But the index I actually have now started liking is the index which is used as a benchmark for all multi-cap funds.
Okay.
So multi-cap funds, if you would know, is 25% minimum investment in large, mid, and small cap, and the remaining 25% the fund manager can invest as per their preference. So the index that they benchmark their performance against is the Nifty 500, 50, 25, 25. There are not a lot of index funds on this specific index yet,
Mm-hmm.
but I think there is one by Navi, if I'm not wrong. So, and I'm sure more will come up. So that, in terms of an allocation, seems like a good index to me
Mm-hmm.
for somebody in the accumulation phase. If somebody needs to be a little more conservative and wants more options in terms of expense ratios and obviously AMCs, the Nifty 500 or the BSE 500 for that matter, I think they work very well. There, your allocation roughly is 68% large cap. It's almost close to a 22% in mid cap and the remaining in small cap. So if it's just one fund, I think you don't need to look beyond this. Now, if somebody is more aggressive and they say, okay, because at this stage, I think you can afford to take more risk. So then I would just go with 3 index funds, one specifically for large caps, where Nifty 100 covers the universe, mid cap 150, small cap 250. So I think there you cover the entire universe and you can decide your allocation as per your risk profile. So I think from investor to investor, your decision will change.
Right, right. So that's about the accumulation phase. Now, moving on to as retirement approaches, in that phase, how should investors change their index fund strategy? Is there a glide path or asset allocation framework that they can follow?
So yes, I think to begin with, you will, if we just take age as the factor, or years to retirement as a factor, because a lot of times people look at different retirement ages.
Right,
You know, if somebody's in business, they might consider 75 or 80 as a retirement age.
right.
So I think obviously your equity allocation should go down with age. Having said that, how you change that allocation also depends a lot on taxation, because
Mhm.
sometimes rebalancing your portfolio for the sake of rebalancing can attract a very high costs.
Yeah.
So when we go around managing different asset allocations, a lot of times we manage the allocation with fresh funds. So, your current allocation dictates, and the allocation you want to see, say, in 1 year's time, dictates where funds which are coming in for investment go. So obviously, equity with time will come down. Debt will increase. The reason for that is that as you approach retirement, you are approaching a time in your life where you will need regular cash flows more. Th- Because when you're working, you do have some cash flows coming in.
Yeah.
And you can't predict when drawdowns will happen. So let's take, for example, if somebody was saving for 30 years and they accumulated a good corpus and they retired in January 2020. Now, in 2 months' time, they lost 40% of their equity corpus. So you can't predict that. 40% is still a large number. They would have maybe saved enough for retirement, but for that period, although the market in this case bounced back relatively quickly from compared with past drawdowns, but you still have that uncertainty. But if they have allocation to debt or some safer assets like gold, they can manage the immediate cash flow requirements from there instead of booking loss in equity and having to dip, at lower values.
Yeah.
So yeah, and that holds true for any other goal as well, not just retirement. If you have a goal of, say, a daughter's marriage in 18 years, and if the marriage is happening, you can see it happening in the next couple of years. You do start moving a little bit of that corpus into debt so
Yeah.
that you don't take a timing risk with your investments.
Yeah. So you did mention lower equity and higher debt allocation, but is there a ballpark number that you would suggest?
So depending on the age, if I have to create a bucket, although again it's not generalized, 20 to 30, I think as long as you're doing your PPF of 1.5 lakhs a year, I don't think you need debt because most of the people are able to manage it with their cash flows, and because they will invest less if they have less cash flows. So there I'm comfortable with 80 to 100% of equity and maybe a 10% allocation to gold that I keep constant throughout your life.
Mm-hmm.
So gold 10% is, I think, you should do irrespective of which life cycle you're at. As you move into the phase where you're between 30 and 40, I think you need to introduce debt a little more aggressively. So you can introduce it to the tune of 15 to 25%.
Okay.
And as you approach 40 to 50, I think you can take it up to about a 35%. And as you, I think, are, say, in the last 10 years, 10 years to retirement, or you're 50 plus, I think one should consider maybe a 45-45 split between debt and equity and a 10% allocation to gold. So then I think one is very comfortable in any drawdown or any, adverse situation.
Right. Now comes the third phase. Once you retire, are there good passive options available to generate income then? And can debt index funds or target maturity funds, can they play a role there?
I think they do play a role. But again, taxation will, have its role to play. Target maturity funds are actually a very good option because you know your duration and so you know exactly what to expect.
Yeah.
Um, but I wouldn't stick to indexes because a lot of, as you approach retirement, I'm assuming you become a senior citizen. So for debt specifically, I'm not a big fan of index investing.
Okay.
Uh, because I think as senior citizens, we get a lot of options by the government, which are very safe and they give higher rates of interest and they give more flexibility in terms of even a monthly interest payout or a quarterly payout. Even we see a lot of people being interested in InvITs, although that's a little higher risk.
Hmm.
But they provide that quarterly payout, and normally what you earn is a little higher than the FDs with your main board banks.
Hmm.
So, um, yeah, I think debt has many options. Tax-free bonds, I think at any time are a good option the moment you look at very long-term tax-free bonds, especially if you're in the highest tax bracket.
Okay.
Like we've seen cases where clients bought tax-free bonds 20 years back at 8.5, 9%. Now 8.5, 9% tax-free in your hands is wonderful. And even now you get it at 5.25. So, by the time you reach retirement, I think 5% tax-free income will also become admirable because inflation has gone below 5% for us. It might not sustain, it will go up and down, but I think long-term inflation does come down.
Yeah. So you've been mentioning taxation. How does the tax treatment of index funds stack up against NPS, annuities, or traditional pension products?
So, index funds get taxed the same way as equity would get taxed. So, after 1 year, 12.5%. In this case, I'm assuming there'll be no short-term capital gain because we're planning for retirement. NPS actually is a wonderful product. And I think the biggest advantage of NPS is what you mentioned in terms of asset allocation. You can make 4 changes a year,
Yeah,
and you
really.
can, yes, and it's not taxed.
Yeah,
There is no transaction cost. So I think in that is the biggest advantage of NPS. My only problem with NPS, and I hope they are, I believe they're already increasing the withdrawal limit
yeah,
once you reach maturity from 60% to 70 or 75%. But that the only problem I have is that you can't withdraw your funds. You have to compulsorily put a portion of it into annuity, which also is good cases for somebody who's not as financially disciplined. But I think if you reach retirement age, many people do gain that discipline by then.
yeah,
So I don't like the. I mean, it. I think it's a little uncomfortable to not have control over your money.
exactly.
That's the only negative.
Right. And how about other traditional pension products there when you're
So
comparing the tax treatment?
Other pension products, obviously, many people do invest in ULIPs. They've been very popular in our country, or other insurance plans for pension. Uh, Doing that now is a little difficult because the limit is that if you do it for more than 2.5 lakhs per annum, the premium, it becomes taxable.
Yeah.
And that has taken away the main, I think, attraction for investors doing it, because in terms of returns, they are very comparable, and in a lot of cases actually slightly inferior to index funds or actively managed funds. So
Mhm.
I think that being tax free was the major advantage there.
Yeah.
Having said that, there are also products which the guaranteed products, I think on the ULIP side, they still make sense for many people, because there you know the payout you're going to receive. But again, that comes to your 6.5, 7%,
Yeah.
where I feel tax-free bonds then make more sense if you're willing to, invest for that kind of a period. So yeah, that's
Okay. So, Madhav, one last question. For someone retiring today and wanting a low cost passive setup, how would you suggest structuring that portfolio? Any practical examples or tips would help?
yes, definitely. So I think how I would ideally structure it is do an allocation of about 10 to 15% in gold. That provides you some safety in the very short term in terms of volatility. I would steer clear completely of small caps. So do either a Nifty 100, a Nifty 50, or at best a large and mid cap index, um, and allocate almost 40% in that area. um, Debt should be about 50% of the portfolio. And within debt, obviously, one can look at a division where if somebody is eligible for the senior citizen savings scheme of the government, I think that's a wonderful investment to make at that stage. One can also look at, like I mentioned, InvITs. InvITs provide a quarterly income. So although it's not monthly, but it's still regular income in your hands.
Yeah.
Um, uh, so that is there. And I think that will broadly cover your 100%. So you're looking at 10 to 15% in gold. You're looking
Right.
at about 40% in equity for giving you the higher growth. And you can obviously give it time, and you can set up an SWP maybe 2 years later or 3 years later, depending on how the initial years go. If you get a good few years in the beginning, then the SWP will make sense. But if you get a few bad years, you have to wait it out. That's why we are going higher in debt. That we'll make our withdrawals from debt till the time equity gets time to generate some returns as a buffer. And yes, and debt, I think choose funds where the exit load is not really there, so that even if we need to withdraw very quickly, we can start withdrawing from the next month itself. But normally, I like to keep cash. So if in case we are planning with a lump sum, because a lot of people get a lump sum when they retire.
Yeah.
So my suggestion normally is to keep 1 year of expense in your bank account, in your savings, because as a senior citizen, you get favorable rates in the savings account as well. So that for the first year, you're not worried about cash flow. So
Right.
you can fine tune it to 6 months, but 1 year just gives you that mental peace of mind.
Exactly. Okay. Great. Madhav, with that, we'll have to wrap up this conversation. That was a fascinating discussion. Thank you for breaking it down so clearly. Thanks.
Thank you so much.
We hope this conversation helps you think through your own retirement strategy, whether you're decades away or just about to start drawing from your corpus. Thanks for watching The Index Investor. Don't forget to like, share, and subscribe for more conversations that make investing simpler and smarter. Thanks for watching.